Hey, I'm Rob Tobias. I'm the managing director of Elite Franchise Capital. Elite Franchise Capital is very unique. While it's a private equity fund, myself and my partners are really just development people. My background for the last 30 plus years has been in franchising. I've been on the franchisee. I am actually still a multi-unit franchisee of Hand and Stone. I've been a franchisee of other brands. I've been an area developer of other brands, and I've been on the franchisor side. So all of that led to us, myself and four partners, creating something unique. And that is Elite Franchise Capital. Uh, Misnomer, and if I had a chance, I'd rename my company because we really don't deal in capital. What we deal in, which is most important for brands, is development. Our brand or our EFC is about bringing together emerging franchisors and aligning them with franchisees, multi-unit operators that could help them develop. On top of that, what we bring is, as I keep saying, myself and four partners, and 90% of our investors all come from the franchise world. So we have a tremendous amount of intellectual capital that's been built up over literally hundreds of years of franchise experience that we use to help our franchisors and franchisees succeed. And the hope is to get our brands to develop sustainably. And sustainably means to help brands, franchisees be profitable, help franchisors support that development, and then help our brands, our franchisors get to a liquidity event in the most optimal way. So, with that,
I guess, Rob, do you mind just fleshing out when you say liquidity events, what do you mean?
yes, sure, great, Greg, love it. Liquidity event really means most franchise brands sell eventually. Somebody comes in and purchases that. Why? Uh, Most brands, franchisors, start off the same way. Somebody has an idea for a pizza concept. Somebody has an idea for a gym, pet grooming, kids education, whatever it might be. They open up one, two, three locations. Then they say, hey, you know what? I really think this could work, and I'd really like to open up a lot more. However, I don't have the capital and I don't have the HR, the manpower to do that. So bingo, they're like, hey, let's get into franchising. And they do. However, franchising and being an operator are two very unique businesses. And so the person that starts off a brand, more likely than not, over the course of, call it 10 years, 15 years, if they are lucky enough to get a brand to 100, 150, 200 locations, they eventually move out of their skill set where somebody else should come in to help that brand grow further. So they look and somebody purchases that. So that would be a liquidity event. What we're here to do at Elite Franchise Capital is to help these brands at an early stage. Typically, we'd like to look at brands between 10 and 30 or 40 locations and help them grow to that 100 plus with both development and then, as I said, to help them figure out how to do things better, not to make the same mistakes other brands have made. Something I love to say is the most valuable asset or commodity we all have is time, right? You can't make more of it and you don't know how much you have of it. And too often, brands spend a lot of time making mistakes that the hundreds of other brands have made before and wasting that precious time. So for us, we're like, hey, we come in and say, we understand why you want to do this, but let me explain to you what it's going to look like a year from now, 2 years, 3 years, and why you shouldn't do it. And so hopefully we help these brands retain those precious resources so they could use that to help them towards sustainable development. Did I answer your question, Greg?
Yes. So
That,
basically, so for the first time, I'm just going to reframe it. So the
Sure.
first time when a franchisor sells, usually at a higher multiple than franchisee sell, the franchisee will get a cut from that, but they have to go through your program.
Yeah, great. Thank you. Thank you. And I was going to get to that on the
Okay,
deck.
cool.
So
I'll let you keep
that
going.
no, no, no. You bring up a good point. So what is really unique about our company is a franchisor, the holy grail, the most valuable asset are successful franchisees. Every time a brand grows and they open up a new location, there's a risk. And that risk is multifaceted. It could be a new location, a new region, or it could be a new owner or operator, and they don't know how well they're going to do. So by the time we're done with this webinar, I will bet you I have 3 to 5 different emails from different brands saying, "Hey, Rob, why don't you take a look at us?" Why? I'm not God's gift to this world, but it's I've proven that I know how to open up locations, so I minimize that risk for that franchisor. So now, if you look at the franchisee, most successful franchisees, especially if they started early in a brand, have helped that brand grow. Yes, they've built their asset, those locations that they had, and they got something for it. But what I realized early on in my Quiznos days, because I helped do the dog and pony show when they were going to have a liquidity event, the franchisor is the more valuable asset. And franchisees that help a brand grow, when that liquidity event does occur, they don't have equity in the franchisor. They don't get anything for helping that brand grow. Yes, they own their individual locations. So Greg, to your point, our fund for the first time allows a franchisor to get what they want, which is multi-unit operators, successful business people. And multi-unit operators, for the first time, because they didn't even know they could do this, get a piece of that liquidity event. So it allows them to do something and get something that they wouldn't have done otherwise. And that's the unique aspect of our fund. So if we go back to the fund, we are only looking to partner with 5 franchisors. Currently, we have 2, as you'll see on that screen, Topsail Steamer, who happened to be on Shark Tank in October of last year. Topsail Steamer is, for all intents and purposes, very unique, never been done before. It's not a restaurant. What it is take-home seafood. You're getting a clam bake that's assembled for you at a location. You take it home, you put 2 cups of water or 2 cups of beer in the pot, which you get the pot at Topsail. It's a one-time reusable pot. Put it on your stovetop. Half hour later, you dump it out and you have a beautiful clam bake. So it's for all those consumers that don't want to go out to eat, but want more ownership in their meal than just getting a delivery. The beautiful part as a franchisee of that brand is you don't really have to know a lot about food. You're not cooking anything. There's no stoves, there's no hoods. All you're doing is assembling seafood into a pot and giving that to the consumer. So it's a very easy brand. Our that one has 13 locations open. We just opened our second EFC franchisee in West Palm Beach. It's set all kinds of records for its first month, so it's kicking some butt.
That's awesome.
Our second is called Scissors and Scotch. Scissors and Scotch is a high-end men's grooming. So it's meant for the consumer that wants something a little bit more from a atmosphere, ambiance, quality than they're going to get from a Supercuts, Great Clips, or so forth. It has a lounge in the front, so you can get an adult beverage. It has wood and leather, and so it's a more masculine feel. Because traditionally, most men, if they wanted a nicer experience, they would have to go to a more female-centric salon, and so it's catering to that. And Mintel has shown that men's grooming habits and purchases are growing way faster than a lot of other consumables because they want to spend more money on themselves. And haircut is obviously a very important part of that. Uh, S&S, as we affectionately call it, has 35 locations nationally. We opened up our first with them just this past month in Wheaton, Illinois. Again, kicking some butt because they set a record for most founding memberships for that brand. So, um, going to
Sorry, I just had a question about
yeah,
the model.
sure.
So scissors and scotch, it's not like a one-time thing. It's more like a membership model
Exactly.
for
Perfect. Thank you. I
customers.
agree. Great question. So that's the beauty of this brand. I own myself as a franchisee, Hand and Stone, and so that's a membership-based model. Membership-based models for owners are important because you have recurring revenue. It makes it easier and more profitable because it's been shown members spend more money than non-members. They're more loyal. And so, yes, Susan Scotch is a membership-based business. And also, unbeknownst to you, one of the keys that we're trying to help them with is while they are a membership-based business, they really haven't done a lot with their memberships. They have a very low membership rate. And so we started at EFC a pay-per-service to help our franchisors. And the first thing that we're doing for Susan Scotch is helping them better their membership-based model, how to come up with scripts, how to sell better, how to make it more enticing for the client. So yes, it is a membership-based business.
And I think I'll be jumping ahead now, but I'm just curious. So like Top Sale and SNS, how many, if like at what point in terms of number of franchisees, if you had to speculate, and maybe you don't want to answer this question, will, you know, like what is their path to an exit in your mind
For the franchisee or franchisor.
for the franchisor?
So no, I'm happy to say that. Like so, as I said, our aim is to get our brands greater than 100 locations. That, for whatever reason, probably because it's 100, right? That's just like
Nice
this
number.
number. Everybody says 100. In franchising, only 17% of franchisors get to 100 locations. I don't have statistics, but I would surmise a good portion of that don't make it there, not because they don't have a good concept and not because they don't have good ownership, but more because they don't have the wherewithal and the guidance to help get there. It takes a long time, and to learn how to be a developer, as I said earlier, being an operator is way different than being a franchisor, and there's a learning curve there. And again, that is where we come in to help expedite that process, but never to expedite it simply for development's sake, which unfortunately is done too often in the franchise world. It's all about sustainable development. And sustainable development means, by its definition, something that can be sustained. And the only way to do that is to make sure that the franchisee is profitable. And not just profitable, but giving a return on investment commensurate with the risk and what the franchisee needs to live on and to redevelop, right? To open up additional locations. And in order to do that, it's to help the franchisor create the infrastructure to actually support that franchisee. Franchising, in its essence, is saying to a franchisor says, "Hey, I created this operating platform. I built this box. If you buy this box, you pay me a franchise fee, but more importantly, this royalty. If you take this and you listen to us, you have a better chance than not to be successful." And prospects buy it because most people are not entrepreneurially in the sense to create a new brand or something. However, what is not done enough is Yes, you could collect that franchise fee. Yes, you could collect that royalty. But if you're not creating those systems to actually support that franchisee, you're inhibiting that growth and it's not sustainable. So, what we do, and I know I'm making this long winded and probably more complicated than it needs to be, we want to make sure that that franchisor has that infrastructure that builds that support for that franchisee so that they could go out there and do and follow those protocols so to be successful. And if they do that, they're going to continue to open up locations. And if they do that, they're going to be good validators for other prospects that come in. Right? And if we go forward, and I know we're not really looking at my slides, but that's okay. EFC only wants to be maybe 20 to 30% of any brand. We sign agreements to open up about 40 locations per brand. That's what we did for SNS and Top Sale. But our expectation is to get them to 150, 200 locations. Well, if you do the numbers, that's 20 to 30% of that. That still leaves 70 to 80% of development for each brand. And to get there is, and I'm sure people that are listening, and if you're looking at other brands, you always want to talk to people within. Who's a franchisee? How are they doing? And if they're not validating that concept, it's kind of hard to get other people in. So for us, the best way to validate is to make sure that that franchisee is successful. And if they do, that other 70 to 80% that come in will come in an expedited fashion because there's a reason for them to want to join that company. Did that make sense?
Yeah, that makes sense to me. And to be honest, I am looking at your slides, but I don't know if you want.
I'm not though. I'm just talking.
Yeah.
So, um, in looking at this, so it's that shared growth, shared success. That's big for us because in life, like anything else, I just had meetings at my spots. How do you balance short term and long term, right? We never in our brand, we always make sure that we never sacrifice long term vision. Again, I come back to the same thing. That leads to sustainable development. Too often, especially in the franchise world, unfortunately, which is approaching a $1 trillion industry, there's too many people looking for short-term gains that don't care about the long-term health of that franchise ecosystem. That franchisor can't just develop for today. They need to make sure that they develop sustainably, which leads to um, more development and more successful franchisees. So for us, we're tying together everything, saying, what can we do in the short term to ensure that long-term focus of getting that brand to a liquidity event at its highest optimization? And if we do that, every participant benefits. And that's where we talked about for the first time aligning franchisor, franchisee, and investor all around the same thing, and that's the franchisor's liquidity event. Um, I think we kind of went through a lot of this stuff. All right. So let me talk about this. I keep talking about tag along rights, right? Which doesn't make sense to a lot of people. What are tag along rights? Tag along rights are a type of equity, but the equity is only realized at a liquidity event and solely based on what's actually developed. At EFC, we're willing to take the risk and say, you know what, if we don't perform, you pay us nothing. But if we do perform, you're going to pay based on what that performance was. And so what that means is if we take a look at a real live example, and this will be scissors and scotch, we're looking for an exit from them in 6 years. This is in conjunction with what their thoughts are, the three founders of that brand. They're looking to have about 150 locations at that time, about $1.5 million in average unit volume or sales per unit based on where they are today and looking at some escalation over those 6 years. We're looking to have 40 units in the under the EFC umbrella. So that comes out to 27% of that. If that occurs and the franchisor sells at a multiple of 8, the expected value is $120 million. Our portion of that would be 24 million for EFC. The beauty here is, though, the franchisees that opened up those 40 locations right off the top from the fund, out of that 24 million, $4.8 million gets shared by those franchisees. So not only do they have their units and the value of those, they get a check cumulatively for $4.8 million for doing the same thing they would have done in any other brand, and that's simply being good franchisee. The value to the franchisor was, we helped you get there with all this development, all this support. And obviously then the value to our investors is they get a return on that. They get the balance of that 19, or they get that $19 million. Did that make sense, Greg? Ma'am, was that?
Really? I think I just have a question on this point. So this sounds like one of those things that is like just too good to be true.
Mhm.
I'm sure like, as you present this to people, like you get surprised looks. So just to give the audience like a little bit more context of like, why does this deal make sense for the franchisor, for EFC, and then for the franchisees?
Yeah, you know what? I really do think this is too good to be true. We do, and honestly, we do get that because people look and say, because it hasn't been done. In the 3 years since
Exactly.
we created this, nobody else is doing this. One is because it's really hard. Like, sometimes things that look easy are not. Okay? Helping a brand grow, especially when they're small, is difficult. It's difficult to help them create the infrastructure because they've never done it before. So on the franchisor side, we spent a lot of time, a lot of effort. When we initially started EFC, we thought we could just mentor, coach our brands. Mentoring and coaching is not enough. Because if you think about yourself, if somebody just says to you, hey, you should do this, even if you think you should, but you've never done it before, in your hectic day with all the things that you need to do, you procrastinate because you don't know what you're doing, you don't know how to do it, and nor can you delegate it because you don't have the resources or the infrastructure to do it. So we learned it's not enough just to mentor. And that's also where a lot of the vendors and suppliers in the franchise world are not succeeding in supporting the franchisor. But so giving a lot of high-end guidance, but nobody's actually rolling up their sleeves to execute what needs to be done. So we realized what's really hard is to roll up the sleeves. And that's why we started a pay-per-service, because maybe it's not that easy, right? So from that side, why did our two brands align with us? Because they needed development and they wanted multi-unit operators. And we have a list of 600 or 700 in our network for all our partners. And so we're a matchmaking service. And we said to them, hey, we could help you do that. But then we realized they needed more help than just that. And then on the flip side, what we thought was, hey, we're going to give our multi-unit operators, our franchisees under the EFC umbrella, these tag-along rights. That should entice them enough to want to take a risk of going into smaller brands. But that wasn't enough either because they needed more validation from the brands, which goes back to the same thing, why we started a pay-per-service. You need to actually show people what can be done. And so putting all that together does work. We've proven it can work, but it takes a lot of hard work and everybody working together. So yes, this opportunity is a too good to be true opportunity because it's not out there, but also it's going to take a lot of hard work and effort. And those people that want to come in under the EFC umbrella as a franchisee need to understand it's going to take a lot to help these brands grow. But if you do that, you do the hard work, you help this brand grow, or any of these brands grow, you have more upside. You also are contributing in a more beneficial manner to building that brand. Did that answer your question?
Yeah, definitely.
So I guess I should just like I'll sort of reframe this, Rob. So we do
Yep.
see like a lot of times the biggest PE firms or like the most sophisticated institutional investors, they want to invest into brands that are already super established.
Yeah.
And then we also see sometimes naive franchisees, they go into a concept. Basically, early franchisors, sometimes they attract naive franchisees that are really in love with the product, like the novelty of some new products. So it seems like what you guys are doing is you've done due diligence on very few specific concepts. You're going to do max five. And it's almost like you are investors, but you're not investing necessarily cash, but you're investing by taking risk early in brands you believe in, and then naturally you expect to get a payoff for taking that early risk.
Yeah, it's all of the above. Going to cash though, we don't put cash in the franchisor. We're willing to back our franchisees. Some of our franchisees 20%. So our West Palm Beach top sale, we're a 20% equity owner. So we're putting our money on the development side. So that is correct. Um, there, I'm trying to frame how the opportunity is immense. The effort to get there is equally immense. And getting all parties rowing in the same direction, that, going Marion, back to what you said, that's the hard part. Making sure that everybody has that long view and is all pointing in that same direction. And how do we help each of those parts do it? And yes, Greg, there are people that get involved and they don't do enough due diligence to see, can that brand support, right? Can, there are development companies that say, hey, we're going to bring a brand 100 franchisees, and they do it. Let's say they do it, but that brand has no infrastructure to open up those 100 locations. And if you're one of those franchisees that gets involved in that and you have no support and you've never done this before, your probability of success greatly diminishes. No matter how good that brand might be conceptually, you need that support, and that franchisor needs to be able to have the wherewithal to do that. And that's where we come in. We're very selective. When we're looking, it takes us a long time to find brands. If we break this down and say, let's say 49% of that due diligence is, what is the brand? Do we believe in the service? Do we believe in the widget? Do we believe that it could work nationally? Do we believe that it can give the return on investment? The brands we look at, we want to have confidence that they could drop better than 18% to the bottom line. We want to see that the return on investment to our franchisees could be had in less than 36 months. So what that means is, if it's going to cost you $500,000 to open up a location, you're able to cash flow or have profit within 36 months, $500,000, which is hard to do. We also want to make sure that the average unit volumes are approximately $1 million, because a lot of our multi-unit operators, if you're giving them $100,000 revenue, and even if they drop 20% to the bottom line, going back to what's the most precious commodity we have is time. For them to make $20,000, it doesn't make sense for them. It's the same amount of effort probably to do $1 million location or 100,000. So if that's 49%, the 51% is, who's the founder. We look for founders that are vulnerable enough to say, I don't know, but strong enough to say failure is not an option, that when I do know, nothing's going to stop me. And so putting all that together is a lot of our due diligence. Another part I will say, not only do we have our 5 partners that evaluate each brand, we have a board of advisors that are made up of our investors that will look at it. Another part is if you are just a prospect, you have to go to each brand and get their FDD, the federal disclosure document. The only financial information you're going to get is from the item 19. A franchisor is not legally allowed to talk to you about any number that's not in the item 19. If they do, they're setting themselves up for a lot of issues. Otherwise, you need to go to other franchisees to get financial numbers. Because EFC is a sophisticated investor, we're permitted to get more numbers. So we will not do a deal with a franchisor unless we see the profit and loss statements for our franchisor's locations. So we get more information, and then we're also going to try to validate that with their POS system and so forth. So we do a very deep dive into these brands, which does set us up. Another part is we do require our franchisors give our franchisees a 50% off the franchise fee if they're under the EFC umbrella. They also get a royalty reduction for the first 9 months of a location. All of that is because the capital is king. We want expedited development, and so it affords our franchisees more capital to open up locations faster. On this slide, and a lot of places you go to, they just say things, they have mottos or whatever, and they doesn't really mean anything to them. Myself and my partners, we've seen the good, the bad, and the ugly in franchising. And what we're trying to do is add integrity to this. And we're committed to doing it. And that's why we're very selective of who we bring in and what we bring in, because we want to do this the right way. I'm not so utopian to believe that everybody does everything selflessly. I do believe that there's a better way to do it. I believe that there's a way where there's a win-win. And that's the premise of this brand, that the franchisor, franchisee, investor all win. You're never doing anything where it's I win, you lose. I keep talking about my partners. James Ball, I've known James for 25 years. James is the president of Grassi Franchise Accounting. His sole business is franchisees. That's what he does. That's his day job. He is a director in this and helps us vet all of this from the accounting side. John Raymond is affectionately a consigliere. He counts as his client's first generation McDonald's. That will tell you how senior or seasoned he is. John is or was a 25 unit EWC European Wax franchisee. He's selling his last 2. He's building a portfolio of Kid Strongs as he's helping us here. Steph comes from a family, I think his parents and his grandfather opened up, I think it was the 3rd Texas Roadhouse. He then started with Orange Theory Fitness at corporate, went on to be a franchisee, and he also is doing Kid Strong. And then, as I said myself, I've done this for 30 plus years. Brands Quiznos, Hurricane Grill and Wings. I'm currently a Hand and Stone franchisee still. As you can see on this, none of us are finance guys. We understand that, but we come from this from a very different perspective. We come from this from a development standpoint. And Greg, you had said something earlier. We deal with other private equity funds because we are a feeder for them. Right? They want to come in and they want to be able to buy a brand and be able to return to their LPs. So most private equity need to buy an asset, whereas we're developing an asset. We're working in conjunction with them to say, okay, what are the checkbox you need to see for you to purchase it? Is if we do that, we know we'll get a higher multiple for our brands. So we act as an incubator. I guess that's the better word for it, for private equity, to help them do something that they're not strategic at. They're better at finance, they're better at legal, we're better at development, and to tee those up for that. So that's the part I think, Greg, I didn't answer. You had said something earlier about that. So if you look at the ladder of how things go, when I sit on private equity panels, all of them sit after me, and we're listening to, okay, what is it that you're looking for, so we can help our brands grow to that.
Yeah, I guess one question I had, like, I think it seems like it's good to have, it sounds like you have some advisors, but it seems like it's good to have
Yeah.
like John on the board because is it the definition of a liquidity event? Is it like rock solid? Is there any way, I guess part of it is trusting the franchisor, the founder, but is there any way private equity can invest? Maybe they don't sell the whole thing or how they define it,
Mhm.
where you think you might not get the payouts?
So we're only counting on the 5 brands, 1 or 2 having a liquidity event, right? This is not 100%.
Right,
That would be foolish.
right,
So that's one. Two, we don't control the exit.
right,
That's the beauty for our franchisors. We don't mandate they have to sell. We're going off of probabilities. And if you look at the history of franchising, the vast majority of brands sell. Because as I said before, if you look at the personality type of a true entrepreneur, that differs or that separates as a franchise grows. You're no longer more entrepreneurial when you get to 100 units. You're creating systems, processes, right? And it becomes more bureaucratic, which is not what a founder typically of a franchise is skilled at. And then the chips on the table become too valuable not to take off. And it's not something they enjoy. So we look at this and say, I don't need to mandate you to sell because the probability is in 5 to 10 years, if you have that asset, you're going to want to. Right. So that answers that part of that. If a and not every deal, and Greg, you know this from your background, not every deal is 100%, right? You don't take all the chips off. EFC gets the same proportionate share. So the tag along rights, if you're selling 50%, then we get 50%. We still
got
hold the other 50%.
got it.
I think that's what you were alluding
Yes,
to.
yes, that is what I was worried about. So that answers my
Yeah, yeah, yeah. And I've also learned through experience, sometimes your contract, the too wordy it is, the easier it is to get out of. Ours is very simplistic, but more difficult to get out of.
Yep.
Um,
So,
Good.
oh, the question that I had, so, when the franchisee steps into the system, so they have this relationship, let's say, with their customers, with their team, and with the franchisor. So the EFC team, right, is like an additional stakeholder in this like project, right, multi-year project. But yeah, how do you see like the relationship, like, like many times franchisees are concerned about like control, stuff like this, like people that they have to report to. So yeah.
Yeah, great question. So when we first started talking about this, even like when we take a 20% equity stake, we I don't want Big Brother hanging over me. I'm that person. I don't want somebody telling me what to do. We're there as an asset, whether it's the franchisor or franchisee, right or wrong. Another part of our modeling, it's trust that we align on that. We're not telling you what to do, but at the end of the day, even our larger franchisees, and we have people in the system that have opened up, we have investors that have opened up 50, 60 European WACs. We have people that have all the way down to they'll open up 2, 3, or whatever. When you're an owner, and Greg Merriam, I'm going to think that you're going to agree with this. When you start something and you're at the top, it's pretty lonely. You're expected to make decisions and you don't always know the answer. We, on both sides, the franchisors and for the franchisees, we're aligned with you. We want you to come to us and say, hey, you know what? I don't know. And it's a safe place to be because you're not judged. It's simply, hey, have you thought about doing it this way? Or, you know what? Let me go talk to this person because they've done it. So the idea is to get more information, better quality information, and support to both the franchisee and franchisor to help get them more efficiently to that liquidity event. Keep asking questions. I work well with that. As I said, what I popped up there a little while ago is just we formed a board of advisors. We thought when I started this, because I keep saying the same thing, I'm not a private equity guy, and I came up with this idea 3, 4 years ago, and I did a crash course in private equity. I had some good friends of mine that sat down for many hours to help me, but they also said, you know, it's going to be pretty hard to raise money. As a funny story, at the end of the process, when we finally put this all together, I went to the same people and I said, hey, how about investing in this fund? And they said to me, how did your last fund do? And it was a nice way of saying you're too risky because I don't understand this. We then went to our network of people in franchise. So that's why I say to you, 90% of our investors looked at our modeling and said, oh my God, I've never seen this. We see the niche that this fills. But in private equity, you have general partners, which I am and my 4 other partners, but then you have limited partners. By definition, limited means, hey, pretty much give me your money and then we'll give you a check back at the end. But we're not really looking for anything else. And we've realized we have this tremendous intellectual capital because 90+% of our investors have so much experience. And we said to them, help us do that. Don't be limited. And so we came up with this board of advisors, and any LP can be part of this. Chris Labashak is I think he's a 7-unit Orange Theory franchisee. He's also the president of Orange Theory Fitness's franchise board, which has like 1,000 members. So we have a lot of skill and a lot of knowledge that we wanted to share. What did I miss? I'm done with my slides.
Yep. So I guess sort of going back to the beginning, do you mind like if we focus a little more on the specific concepts you have? So
Yes,
for example,
absolutely.
if you walk us through the top sale, the opening, the kind of operator you met, like what kind of support did you give them in opening? How did they break the records for the first month? What are the specific things like the operator had to do and that you helped them with?
Great. Thank you. That's a good place to go. So sticking to your line of questioning with Top Sale, we partnered with a husband and wife, Kate and Kyle McGough, that had never done this before. And we felt confident in them that they had the background that we would bring them under the EFC umbrella because they weren't multi-unit operators. But Kate came from a marketing PR background. Kyle came from more operational, and so we supported them to allow Kate to put together a never before done with Top Sale marketing, social media campaign, where we did not a soft opening, but a really hard opening, where we did a lot of PR. And that's what led to that. And that's what led to Top Sales saying, "Hey, how did you do that? We want to do that for other brands or other locations." Um, and so that brand lends itself to people that don't. It's not operationally difficult. A lot of people are intimidated by food, especially seafood. If you could count to 12, you could probably build a bucket. If you could weigh something, there's no recipes to follow. It's simply, hey, there's 12 clams, 14 shrimp, some andouille sausage that weighs half a pound. All that gets into a bucket. You close the bucket, you give it to the customer. Um, it's also very small. It can be done in 800 to 1,000 square feet. So operationally, it's easier because rent is very expensive these days. Also, what you're going to see in almost every brand post-pandemic, the cost of construction, materials, FF&E, is through the roof. This allows you to do something that could have upwards of $1 million in revenue, and what should cost you 350 to $400,000 to open, all in. Um, what other questions am I missing?
Like, how long does it take to open?
Sure. Any brand, the construction side of this is minimal because, as I said, it's small, maybe 6 weeks, 8 weeks at max. But every brand, the longest period of time is to find real estate. I don't care if it's Topsail, I don't care if it's S&S, I don't care whatever anybody on this call is looking at. Finding real estate is the longest period of time and negotiating that
Yeah,
lease.
so let's say excluding that. Let's say you found real estate or just excluding that. How long does it take?
Well, then it's going to typically on any brand, it's going to take you probably a year from the time you sign a franchise agreement to get open. No different than us. The vast majority of that year is finding that real estate. Getting the location open, you're going to get it open in less than 2 months.
Okay.
The training is a couple of weeks. The support you're going to get, uh, operationally, as I keep saying, it's pretty minimal. It's not that difficult.
So yeah, so how many employees overall will a location have when it's
Uh,
full?
yeah, great question. Again, because it's so easy, typically anywhere from 4 to 6 employees. You don't need anybody who's skilled. The beauty of this brand also is you don't have to pay a lot for your front desk because the average bucket is about $150 and people are tipping off of that. And so the front desk person is really happy because even if they're making minimum wage, they're almost doubling that because of the tips. So it's a nice place. It's an easier place to hire from because you don't need skill, you don't need a license, you don't need people. The job itself, the hours are from 12 to 7. So it's not you don't have to get up early, you don't want to get home late. It's an easy time to hire for. The shifts are pretty much one shift a day.
Yeah,
Uh,
so is it seasonal? Like, is it like will Topsail be
mm,
open?
yeah, so it started off in seasonal areas,
Yep.
and we are expanding it. The only reason we did this is because we believe that this is a business that's not seasonal. That hence where West Palm Beach comes in. While West Palm Beach has a seasonality to it, it's full year round. To your point, original one, the number one location is the first location, which opened up in Surf City, North Carolina. It's on Topsail Island. And they're able to do almost $400,000 months with 7 employees. So think about the volume because it's just a lot of assembling. And so you could scale that pretty fast and you don't need a lot of people.
So are you concerned, like, will it be hard for someone else to replicate this?
Not at all. Nothing's hard to replicate. I would state, tell me something out there that's proprietary.
Right.
Pizza, coffee, burgers, right? All of these things, somebody has a differentiating factor. You just need to play on that. We are the first, or Topsail's the first to market on this. That doesn't mean it can't be replicated. And in fact, it will be. Because wherever there's success, there's going to be somebody else that comes in. The idea is to align yourself with a brand that can exploit that and maintain that differentiation. But if the thought process is, hey, I'm going to find a brand that's going to be proprietary and nobody else can enter, I defy anybody to tell me what that is. Right? And so you need to be there to protect it. And the way you do that is to have really good customer service, to maintain what it is that your customer wants and deliver on that promise. One of the best is a company that you're very well affiliated or familiar with. Tell me why Chick-fil-A is so good.
Right.
Why are they doing so well? It can't be just a chicken sandwich.
I definitely agree with what you're saying. So ultimately, it's like execution day in, day out.
Yeah.
Yeah.
And that's the beauty of Chick-fil-A, right? It
Right.
was, we are going to deliver on customer service. And the way we're going to deliver on customer service is by delivering you a chicken sandwich. It could be a lot of different things, but that their differentiation is not the sandwich, it's how they delivered it. At least that's my opinion based on what I know of them.
Yeah, I definitely agree with you.
And so that would hold true with Topsail. Right now, there's the first position advantage because while there are in coastal towns some places that do something similar, a lot of times it's out of an existing restaurant. It's not their primary focus. There's very few. There are a couple that do just this as Topsail's doing, but not that many. And then with scissors and scotch, now that is a more complicated business. One, you're dealing with stylists, which have to be licensed. Two is it's a bigger footprint, although that's something that we're helping them with. When we first started with them, they were about 2,200 to 2,500 square feet. The build out was about 600. Well, that now that doing that same size will cost you $750,000 post pandemic. So, like a lot of other brands, we've helped them scale that down to its essence without losing who S&S is. And so, getting that down again to where it'd be about 600,000 to open, but it's going to be about a 1,200 to 1,300 square foot location. I The revenue on that is higher because you have people that use it more often. If you have hair, you're getting it cut every 2 to 6 weeks. And so the opportunity is there. That's another one to your point, Greg. Is there competition? Yes, there's another brand called Hammer and Nails that's in that space that's trying to develop the higher end men's grooming. And so we're competing with them. We like to believe that we have a differentiation because Hammer and Nails does both manicures, pedicures, and hair care. We don't believe that the manicure pedicure is sustainable. It's too competitive, not lucrative enough, and therefore your operating costs are higher because you have to have a larger footprint. And so we believe that scissors and scotch is more viable because it's A, less complicated, but B, you're concentrating on something that you can differentiate, and that's a hair care. What else can I tell you about? So with scissors and scotch, typically somewhere between 8 and 12 chairs is the size. Even when we're getting down to the smaller footprint of 1,200, we don't want to get below a 8 chair location. So at the end of the day, you're going to have between your front desk check-in, your stylist. When you get to the 1.5 or greater, you're going to be talking about plus 20 employees. So that is a more complicated business.
Yep. So are there locations like for either of these brands that in your mind are optimal, like right now?
Yeah. So for Topsail, we do believe it's national. They did a deal during the pandemic with a company called Goldbelly, and Goldbelly buys or markets iconic brands for different regions and ships them out. And so with Topsail, they know that they ship out a lot through Goldbelly to the Midwest and so forth. That's not a market where we want as a first position. East Coast, Maine to Florida is a no-brainer. Um, just a little detail. The first clam bake were everybody who got off the Mayflower, because that's what the Indians helped them cook,
Got it.
was a clam bake. That's the first meal, right? And so it's been around since before the United States was the United States.
I know one of my closest friends, his descendants were on the Mayflower. Roger Beeman.
Well,
Shout
and
out to
his
Roger Beeman.
and his descendants, one of their first meals was either venison or clam bake,
Yeah,
right?
yeah.
And so you don't have to talk to people about a clam bake, but they're intimidated by cooking seafood. And this takes away that intimidation and makes it very simple. So I would say East Coast easy, Panhandle from Florida through Texas. Again, you're talking about, they call it different down there. They call it a steam pot, a boil, and so forth. And then you could also go up the coast from, California along there. Again, they're used to doing this. Then once we have that, then we could look at the interior of the country because there's opportunities there. For scissors and scotch, look, you want to be in areas that I would say are upper middle class. You don't have to be affluent. When you look at the customer mix, you'll be in there. You won't know if you're next to a blue collar worker or somebody who's in finance. Men, especially younger than me, 25 to 45, are looking for an experience. They're looking for something, and it doesn't matter. Uh, while I think the average is about $50 a haircut, which is not exorbitant, especially Greg, where you are in New York City. But uh, there's a lot of areas in the country that scissors and scotch fit into. In fact, by the way, it started in Omaha, Nebraska. That was the first location.
Got
So
it.
if anybody, people think, hey, it has to be New York City, it has to be Chicago, it has to be LA. Started in Omaha, Nebraska. And that location does about $2 million a year.
And just to add to this, there is like this term going around these days called third spaces. So kind of like, the space like a coffee shop where people, interact socially and also do something like get a haircut or drink their coffee. So it seems like it falls under that.
Yeah, that's another great point. When we were doing our due diligence, I went out to their corporate location in Kansas City, and I was sitting in the lounge area, and I just wanted to see what a customer thought. It turned out the guy owned a bunch of spas, so we both were in the same world. And he said, you know what? This is my place to get away to. I only have 1 hour. It takes about a half hour to get your hair cut. He goes, I just sit here. If he chooses to have an adult beverage or just another something, he just sits there as a third space, just a timeout from his day. And you don't wouldn't normally do that in another place because there's a loungy kind of area in the front that you're just able to sit there and just relax and use as you want. If you really wanted to, you could go watch a Monday Night Football because they have it on and have a beer. So yeah, Marion, 100%, it's that third space.
So for scissors and scotch, like how do they market it? Like if you were opening a new location, like how will can you give some idea of the local marketing that you might do too?
The local marketing, as I said, it's that to that third space. It is marketing to somebody who wants a nicer experience, but it doesn't cost an awful lot. You're marketing to that person that wants to come in, treated well. I'm old enough, if any of you ever saw Cheers, like you
Yep.
walk in an anonymous world, somebody knows who you are. They recognize you. You get to be someplace comfortable, right? And so that's what we're doing. And there's a lot of social media. There's a lot of um, that kind of marketing to let people know there's an option for you if you want something more than great clips or super cuts, and you want something that's reasonable that will fit within what you're able to afford and allow you to be in a place that you feel comfortable.
So how much does a haircut cost?
As I said, it depends on market. That's always the case for any product. What you could go to McDonald's in New York City and it's different than McDonald's in Omaha, Nebraska. So typically, though, you're going to be between 45 and 55 for a member. It's more expensive for a non-member. I will say to you, I'm advocating for them that they might have to raise it a little bit because the cost of doing business has become much more. But it's somewhere between 45 and 55 right now. And that would be, by the way, there's different levels. You could go for your base, which is what they call a 10-year, because it goes off of Scotch, a 10-year, 15, or 25. So a 10-year, and then a 15 adds a little bit of a massage, and a 25-year adds a hand massage, adds warm towels, and adds a little bit more pampering to that.
Cool. So, and then for recruiting the people that actually do the cuts, do you have to recruit like higher level? Like, is there talent involved with the?
Yeah. So the nice part here is stylists make their money mostly off of tips,
Yep.
right? And so if it's gonna cost you or it's gonna take you 20 minutes to do a haircut and you're gonna work at a place that charges $25, or I could work at a place that charges 45, right? So the idea here is that you can recruit the better talented stylist because you give them more opportunity and the clientele and the atmosphere. So there's ample opportunity, but it is, again, I will come back, no bones. You have to deal with stylists. You have to deal with a lot of them, and you will have to recruit them, and that's going to be a big part of that job.
So where do you recruit this kind of stylist from?
You're going to do like anything. Indeed, you could, you can go once you're established. You can go to the schools. A lot of times, you want that stylist to at least get a little seasoning under their belt someplace else. And then again, it's an opportunity. People are looking for advancement. And I come back to the same thing. If you're a good stylist and you started off at a brand that doesn't charge as much, and you know that you can for the same amount of time earn 20, 30, 40% more, why would you not? So that's where you're getting your stylist from.
And I just have one comment. So, when we look a lot of this like haircut franchises, like you mentioned a few of them, so there's always like a concern of that stylists take away customers with them because people are so like attached to, the
Yeah.
person who services them. And especially, yeah, when they know their name and they've been doing it for a long time. So it seems like with this concept, because the like environment is so important, so the lounge, right, the kind of like higher tier setting, so it's a little bit harder for the stylist to like provide the same experience, just like, at their house or some
Yeah.
other place.
So I'll give you a long-winded answer to that because I live in the same environment. I own spas, and when I first opened them up, you worried about that a massage therapist or an esthetician would leave and take your clientele. And early on, some of the brands were like, "Hey, you had to sign a non-compete and so forth." At the end of the day, what's real? People are lazy, right? Your customer, your client, that home is that spa or that salon or whatever. You're going to lose some of them. That's real. The vast majority are not going anywhere. And if you've done your job at that spa, that salon, or whatever it might be, and you are delivering that customer service, that client's pretty much staying there. The other part is very rarely does somebody take their clientele with them. It doesn't happen. It really, you know, um, and as an owner, I would say to my massage therapist, you're free. If you have somewhere else you want to go, that's great. But you don't own those clients. We brought those in, right? Go and go ahead to wherever you're going, and good luck to you. And I really do wish you that. But I've never really had that many issues with it. And so that's my best answer. I wouldn't worry about that part of it. It doesn't happen all that often. And it is a pain when your best people leave, more because they were really good. And typically, if they have that kind of book of business, it's because they were really good. But uh, yeah, I'm going to leave it at that. And any business losing you really good people is hard. It's more because the person they left than the clients that are taken.
Right.
Cool, Rob. Yeah, this has been super informative. To be honest, I understand the model better now. Thank you for taking the time and sort of explaining, like really breaking it down.
Yeah, my pleasure, and I really appreciate what the two of you are doing. I left obviously the last part up there is contact. You can contact me through WeFranch. My email is on there. My phone number is on there. Uh, any way that you want to get in touch with me, please go ahead. I'd be more than happy to talk to anybody, whether I can help you on another brand or obviously something through EFC.
Awesome. Thank you very much, Rob. We'll be in touch shortly.
Welcome. Thank you.
Rob, take care. Bye.
Take care. Bye.